Hello, everyone. Welcome to TradeFinder Live. My name is Zach from Support. I will be facilitating this session with our speaker, Rob Roy, who I'll introduce in just a few moments. First, let's cover off some important details about the session. So first and foremost, this is going to be our disclosure disclaimer agreement. If you've seen any of our live sessions, whether it be a former TradeFinder session or maybe an insiders meeting, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States. Nothing is to be taken as personal investment advice. We're purely here as educators. So feel free to take a screenshot if you like, but that's the main gist to take away. Next, we have a couple methods of asking questions for this session. Keep in mind, it will be brief in the TradeFinder session when compared to insiders. We'll just open it up for a few questions towards the end. But to go over how to ask those questions, we do have two methods for that. The Q&A, as you can see circled on the screen there, will allow you to write your question in via text. And we'll pass it through to Rob in regards to priority and how many upvotes it has. In regards to the raise your hand icon, that'll actually notify support that you have a voice question, and we'll be able to unmute your microphone and have a conversation with Rob via voice. The other chat window you see there is actually all for attendees and panelists, so just keep in mind no questions will be taken from the chat window. That's strictly for interaction amongst attendees and panelists. So any support type issues, feel free to drop those in there. Lastly, as I said, it's going to be a brief question portion at the end, and we're just going to allow time for a few questions. So if we don't get to your question, just know it has nothing to do with the validity. We just only have so much time. All right. Without further ado, I'm going to go ahead and pass over to Rob Roy.
Hi, everyone. This is Rob Roy, Belly Wave Options, and welcome to TradeFinder Live. Thanks for the introduction, Zach, and then we'll be back to you in a little bit to go through the Q&A. If you're new to TradeFinder, welcome to you. I'll give you a brief rundown of how this works. We talk about the markets, not just the U.S. market. That's what we used to do, but we add in international markets as well because we have a lot of international subscribers, and you asked for it. If you are just interested in trading the US, please don't turn away when we talk about the international markets. All the securities that we talk about are tradable on the US markets, and perhaps we find some pretty good patterns in international markets that can be traded on our exchanges. So it's worthwhile to pay attention as we go. Then we'll do a review of any closed trade alerts that we may have done for our alert subscribers with Elliott Wave Options at EWOtrader.com. Gives you an idea of how our alert service works. We'll go through and review any what would be considered open case study considerations from previous TradeFinders. The difference between our alert service and TradeFinder is with TradeFinder, we identify case study considerations, and you're kind of on your own. There's a lot of alert services that are like that out there where they give you an entry and then whatever you do with it from there, it's kind of up to you. Our alert service is different where we walk you through the entry, any adjustments, and the exit. So we take you by the hand from start to finish of all of the potential trades. So then we will go through and look for any current case studies that might look good for this evening. We'd like to get at least one per week. Sometimes we've added a few more. And then we'll come back with that general Q&A that Zach mentioned to you at the end. That's it. That's how the process works. So without further ado, let's go ahead and get into looking at the charts. Welcome to all of you that may be streaming on the live stream services, social media out there. If you're on YouTube, please take a visit to our YouTube channel. If you haven't looked at our last SPY update, please do that. It's getting a good number of views, so we'd like to have you take a look at it as well. And in that video, we talked about this big zigzag pattern that we have here, which brings us to a potential C wave extension right at 400. And we also talked about how 400 has a gap going all the way back to April. We're big believers that gaps get filled. And we're more than just believers in it. We have the actual data to back that up. I think it's 93%. We did the study going back 20 years of gaps and how often they get filled. And I think the number was 93% of gaps get filled. So it's not 100%. So not every single gap gets filled, but the majority of them do. So when there's a gap, it's worth paying attention to. So when you have one that happens to coincide with a 100% C wave extension, I think that's worth considering. So that 400 level also being a big round number is something that we want to watch. In addition to that, let me take some of this other stuff off. I have the moving averages on here. The lime green line is the 10-day moving average. And you can see that we're not really that much oversold, even with the downward move today. One other thing that we should note, though, is the 10-day moving average is starting to separate from the 50-day moving average. And if you've watched any of my videos, you've heard me say no security in any time frame gets very far away from the 10-day moving average. So we pay attention to that. That's why I noted we actually traded above the 10-day moving average on the high today. So even though we closed lower on the day, we're really technically not oversold from that metric to measure. But we are starting to see some separation between the 10-day and the 50-day. And that works the same way. That doesn't last too long. You can get some separation there, but once it starts to get a little bit significant, you want to start watching that as far as maybe the two starting to come back together. So does that mean the 10-day moving average moves back up or the 50-day comes back down? But they're not going to separate too much further than where they are right now. So as I take them off, what I wanted to show you is we have a new qualified zigzag pattern. So we talked about this big zigzag pattern, but let's just take from that same level here and go down to the extension on that first move and then moving up, and you can see we're right at that 61.8% level again, and that C wave extension brings us just below the 400 level. So there's two different zigzag patterns that are kind of both in the same area there. And so we want to certainly pay special attention to that. With the move to the downside today, that last zigzag pattern actually became qualified. So two different patterns. When we look at this, we had a complex A wave, we had a mono B wave, and now we have clearly with that zigzag located within the C wave, a complex C wave. And that's not unusual. You can have two monos like an A and a B mono. It's pretty rare. It does happen, but it's pretty rare when you have a mono wave A, B, and C. Those are kind of fun to trade because they're really short term, but it doesn't happen that often. When you have a complex wave, what that really means, if you're new to Elliott wave, is that you have a wave within a wave or a pattern within a pattern. So you can see we have a corrective move within this pattern. So that move down here was the A wave, and then the B wave correction, all that's located within that big C wave that has the extension target around 400. So two Elliott wave targets now, both zigzag patterns, giving us targets in that 400 range or just below it. So something that we really want to pay attention to is interesting on the SPY update. And again, if you want to go take a look at it on YouTube, I asked people, do you think the bottom is in? Was this low here that occurred on the 24th of February, was that the low? And it's interesting to hear differing opinions because that's what makes markets, right? Differing opinions makes a market. And so listening to some of the conversations regarding that, perhaps the low's in, perhaps it's not. I'm a big believer in this zigzag pattern with the 61.8% B wave correction, looking for 100% C wave extension. So I'm going to give that the benefit of the doubt. You can see we traded right down to the 430 level. There is a little bit of support here right at the 430 level. And then we have that big Fed meeting tomorrow. So that could be a wild card. I mentioned this to our subscribers in a post last night that if we kind of churn here for a couple days, which with the Fed meeting tomorrow, probably not going to happen, but we're starting to build just a little bit of a triangle pattern here, which again could encompass that complex C wave, but that would imply that we go sideways for a few more days. And with the VIX above 30 and the fact that the Fed announcement is tomorrow, I would think that's less likely to occur. But again, something to pay attention to with the fact that if we do churn here just for a little bit, setting up that triangle, that's a very large triangle for the move in the S&P, and could really set us off for, do we go down to the 400 level, or do we reverse and head back to the upside? So is the Fed going to go 50 basis points tomorrow, 25 basis points? I don't know. We'll wait and see. But that's certainly going to be of interest. All right, looking at the Dow with the diamonds, checking some of the different markets, you can see that we have a wave 3 here. The wave 4 did not label on this move to the upside here on the 25th, the recovery. And if you remember on the Qs, which we'll look at in a moment, we had a impulse pattern to the downside there where we had a tap box 4. That's a projection 4, means that if you get a retracement in the wave 4, it could possibly label there. It didn't label in the Qs, which meant that we're likely getting a lower low. It hasn't labeled on the Dow yet either, and the same rule applies. With this bounce back up, it was actually this high here on the 25th, was within this tap box, but it didn't label that as a 4. So that likely means we're going to have a lower 3 on the Dow. And so the low here was 322.69. So yikes. That's just a wave 3 lower. So if you get a wave 3 lower, that means the wave 5 is going to be even lower than that. So it doesn't look like we're done. It almost felt today, if you watch the intraday charts, and I watched a 3-minute futures chart throughout the market, trading day. At some point in time, we may do a trading room where we actually open up live for a bit in time. Keep an eye out for that if it's something you might be interested in. So you can see what I'm looking at on a live daily basis. But I look at a 3-minute futures chart throughout the trading day, and the way today worked, every rally was sold into. Every time you had a move to the upside, it was sold into. So every time they tried to rally it, it was sold. You couldn't get a sustained upward move. And so that was pervasive throughout the entire trading day. Sometimes you get to the point where the rally occurs enough, shorts decide to cover. The shorts were emboldened today, if you will. They weren't concerned about anything moving significantly to the upside. So we just had the zigzag patterns all the way to the downside. There were several zigzag patterns on the way down today. It was pretty interesting watching the intraday charts as we moved. And that's something that if you're interested in Elliott Wave and you may be newer to it, again, welcome to those of you on the live media streaming services, that Elliott Wave works at any time frame. So it doesn't have to be on these daily charts, on these big charts. If you want to trade intraday, if you want to trade futures, if you want to trade currencies, it works for all different markets and all different time frames. The more liquid the market, the more accurate Elliott Wave is. That's one of the things that makes it pretty unique. So let's take a look at the Qs. I just mentioned the fact that we had this move down. So if I move the chart back a little bit, you'll see what I mean. That back here, see where that hit right smack in the middle of that tap box, and it didn't label that a 4, right smack in the middle of the projection. The reason it didn't label it a 4, don't ask me how. The mathematical algorithm knows this, but we are likely, with that occurring, to get a new wave 3 low. And that's exactly what happened. So those of you that may be unsure of Elliott Wave, maybe a little skeptical of it, maybe new to it, man, this is the place to be. That's why we're called Elliott Wave Options. We will give you the education. We have tremendous education on our website at EWOtrader.com. And if you go through our educational process and you're not a believer that Elliott Wave is at least something that you should add to your trading toolbox, I'd be shocked, because the proof is there. It's just simply there. And that's another example of it with the move to the downside. So look like we're bouncing back. We haven't made it back into that projection of where the wave 4 could be yet, and moving lower. So that means we have a new wave 3 low coming on the Qs. It could be. So, I mean, the market could bounce from here. In the last update, couple people ask about, could we look at the IWM? So let's take a look at it here on TradeFinder. And we've talked about this through TradeFinder for the better part of the entire year 2021, where we had this support level. You can see it right there at 210, and then resistance at 230. It was just an amazing trading range throughout the entire year. Well, we broke that, and then we came back up and tested that level, hitting a high of 209.05 there on the 10th of February. And now we're just kind of hanging here. Now you can see we have labeled a wave 5, but we haven't reached the targeted price yet. So we're within a wave 5, but maybe we haven't reached the wave 5 low. But look, the small caps are hanging in there quite a bit better than the rest of the market is. That's interesting from a risk on, risk off type of environment. I would think the fact that small caps are viewed as normally, they're kind of a bellwether for, is the market in a risk on, risk off type of a environment. The Qs are struggling because interest rates are going up. Or are they? Let's go ahead right now and look at the 10-year, since I brought that up, and look at that. Now, we had talked about this last week on the fact that interest rates had gone up. They got above 2%. I was saying that I didn't think the market was going to like a 10-year at 2%. The market didn't like it, but man, we're not at 2% anymore. Look at this move lower. So what does this mean? This is not good for the equities market, because that's telling you, this is, normally you would think, oh, interest rates are going down, interest rates are going down. So prices going up, that's a good thing for the equities market. But no, even though we have some support right here, as you can see, that means money is flooding into bonds. And so it's coming out of the equities market. So there's viewpoints that the equities market's not done going lower when you have that kind of a movement. However, when we look at the 10-day moving average, you can see that, man, we're actually a little bit oversold on bonds here. You can see the low there and the 10-day moving average. So we're a bit oversold. So perhaps we get a little bit of a bounce back in rates. And wow, isn't this a significant change from back over here when I was talking about rates going up to 2%, that the equities market wasn't going to like it? Well, now we're to a point where a little bit of a bounce back up in rates could be good for the equities market, because that would mean money coming out of the bond market. And you got to really stay on your toes when the VIX is this high, when there's this much volatility. The market is crazy. And I've been a long proponent of, if you want to be an equities trader, you should have at least some sort of a working knowledge of the bond market. You don't have to be a bond trading expert or anything like that. You should have some sort of an understanding, because the bond market is massive. The bond market is larger than the equities market. There is more money in the bond market than there is in the equities market. And the viewpoint is there's a lot of really smart people that are in the bond market. So you want to pay attention to what's going on there. So the first thing is, you see money flowing into bonds, not good for equities. But we are a little bit oversold here. So perhaps we get a little bit of a bounce. Maybe the Federal Reserve goes 25 basis points. There's some speculation of whether they're going 25 or 50 basis points. Could the fact that they raise rates actually be viewed as a good thing? Maybe there's some concern that they actually go 50 basis points, and that's why money's moved into bonds. If they only go 25, then we get a little bit of a bounce back. That's a very, very possible scenario, but I wanted to share with you that bonds are at a potential point of support and oversold at the current moment. Man, just really crazy what's going on. A really good indicator of risk on, risk off, as we've been talking about lately, is Bitcoin. Look at that. How impressive is that move to the upside in Bitcoin? Even with the markets moving to the downside. We're going to look at gold and silver in a minute. Even with the metals moving to the upside, Bitcoin's moving higher too. None of that makes any sense, does it? So the equities market's going down. That's risk off. And they've been telling us that Bitcoin is a perfect example of risk on, risk off. Watch Bitcoin to see what's going on, to see what the general move is or mood of the markets are. And so the markets go down significantly, but Bitcoin is going up. It's trying to get back above 44,000. And you've heard me say this so many times that it's like some sort of a movement with Bitcoin and the number 4, because support resistance is at 44,000, 40,000, 36,000, and then down to 32,000. So it's that every block of 4,000 is a support or resistance level with Bitcoin. And you can see, I talked about this in that last SPY recording. It was pretty impressive to me that Bitcoin held 36,000. Really surprising with everything that was going on. Not only that, now it's gotten itself back above 40,000 and it's trying to get above 44,000. If it does, then we could have a significant move higher. We have a pretty good wave 4 here, though, at a 38.2% fib level. So maybe we bounce back up and that's the end of it. This is it. And we turn and move back down. But there's still room for a higher wave 4, a 50% corrective level, 61.8. We could still bounce higher and have a 5-wave impulse pattern to the downside. But at this point in time, really impressive that Bitcoin has been able to move back up and is testing that 44,000 level again. I think that is just really, really surprising and impressive price movement. So, with where bonds are, we're starting to get where things are disjointed, and that usually doesn't last very long. When the equities market and the bond market and the risk assets, they all kind of line up. So we've got small caps that are hanging in there. They're down, but they're not doing that poorly. And then you've got Bitcoin that's moving to the upside. You've got interest rates moving lower because money's moving into bonds. And then the equities market is moving down. These things don't usually line up that way. So things are going to change here over the next week or two. I talk about that a lot. When things get a little bit disjointed, they don't last that way for long. And the comparisons, the correlations that exist in the market, they all tend to come back together. And so when they get a little bit off like this, there'll be a point where they come back and everything makes sense again. So some confusion now could be because of the Federal Reserve announcement, but I think it's more than that. Is there really concern? I know that the big news Sunday was Putin putting his nuclear team on alert. Is there really concern that we're going to go to that? I don't think so, but man, let's just go ahead and take a look at gold while we're here looking at Bitcoin before we take a look at some of the rest of the markets and look at that movement. Now, I was pretty excited about where we took our gold position off. We did have a long position on gold that we took off back here because we had hit this resistance level. And then we had that big downside open to the markets on Sunday when Putin did declare official war. And then the market reversed and closed on the high of the day, opened on the low, closed on the high. It's like, man, I would have liked to have caught that on Monday, but we came back down. We had a little doji here. Even yesterday was okay, but then, man, look where we are now, right back up here. And it's like, man, we would like to have stayed in just a little bit longer, but that's Monday morning quarterbacking. When you close a position out and you're happy with it, then you stay happy with it. So if you take a look at the DMI, looks like maybe gold isn't quite done yet. Kind of thought we might come just a little bit lower here, so might have gotten a little bit picky on that, on moving in again. But we are in silver, so let's go ahead and look at that. We're going to look at that as one of our case studies because I'm going to show you the case study alert in silver with this big move to the upside here. And look on the DMI here, it's just now triggering. So where gold's move higher looks a little bit more mature, the move in silver is just triggering on the DMI. So we have the ADX breaking up above 20, breaking above the negative directional indicator, good separation between the positive and negative directional indicator, and the ADX is curling up between the two directional indicators, all those things. And again, we have education on these indicators that we like to look at in conjunction with Elliott Wave. We have a handful of confirming indicators that we utilize. And so we educate all of our subscribers on those indicators as well, so that when we're talking about them, they have an idea of what we're talking about. So at this point, let's just go ahead and show you that. Here's the trade on SLV. It was in our volatility strategy, which for those of you that are familiar with our new AI-based time strategy that we just launched, all the information's on the website, so I don't want to go through and give you another hour-long presentation, but we're super excited about it. A strategy that's based on AI data. A couple of weeks ago, CNBC actually had a blurb on the future of AI and how it's going to trade into or figure into technical analysis. And we've already got a strategy for our subscribers based on it. And with the crazy volatility that we have in the markets, we actually added a volatility strategy to our time strategy subscribers, just compliments to take advantage of this, just as a nice thank you for taking advantage of it. So if you're watching on one of the live streaming services and you haven't taken advantage of the time strategy, go to our website, EWOtrader.com. What a great time to be taking advantage of it. If you're as excited about the future of AI and trading as I am, plus you get this bonus here with this strategy. But look at what's going on with silver here. So with the volatility strategy, those are strangles. So if we go back and look at the chart, you can see that we had a triangle here, right there in silver. And at that point in time, the DMI hadn't triggered, so there was no way of knowing which way things were going to go. And it broke to the upside. And so we're up 30% already on the strangle. And that meant that we had both sides covered. If it would have gone down, we were fine. If it went up, great. And so there's the trade there. And when you take a look at this, every one of our alerts that goes out to our subscribers has this page on it. So this is the page directly under trades in our website. And then when you click on the actual entry, it gives you the specifics here. So there's reasoning. So I give you a little bit of a reasoning. We talk more about it in our insiders meeting on Thursday night, but we give you a brief rundown of it. We send these out via text or email. You can see that we had the 23 strike call, the 21 strike put with May expiration, 3 contracts of each. And we also give you the chart. So there's what it looked like. And look at where the ADX was then. Quite a bit different scenario than where it is now, right? But the ADX then was very low. And now you take a look at where it is with silver, and totally different picture. But that's the beauty of the volatility strategy, is it doesn't matter whether that ADX comes up, because the positive directional indicator is in control or the negative is, meaning buyers or sellers are in control, doesn't matter. We profit whether it moves either direction out of the triangle. So I thought I'd give you a pretty good idea here of how our alerts work. And then this is a mark-to-market graph. Every one of our alerts is marked every single day to the market, hence the name mark-to-market. And you can see where every single position is every single day. So with that move to the upside in silver, we have it covered for our alert subscribers. So thought I'd just go ahead and share that with you. Interesting with Bitcoin. So let's get back to the international markets, and we take a look at the XJO, which is Australia ASX. And here we go again with another triangle. Check this out. So we had this triangle back here, which made a really impressive breakout. And now we've got another large triangle setting up here in the XJO. Wow. I mean, really, a really good looking set of lower highs and higher lows. That's a nice looking symmetrical triangle. The only negative here is I'd like the ADX to be lower. Why? Good question. When you have a triangle in the markets, you don't have to have a low ADX for the market to break out. But what the low ADX means is that a particular stock has been in a consolidation pattern for a while. The longer it's been in a consolidation pattern, the more likely it's getting ready to break out. So when you have a triangle and the ADX isn't that low, you can actually form a larger triangle. You usually don't go dead sideways, but we could, break out a little bit here, break back out a little bit there. And it could drag out the formation of the triangle over a period of time, and you form a larger triangle. And when you're putting a strangle on, you're buying a call and buying a put, so time decay becomes an issue. So we like to set up with the lower ADX because it means it's likely to break out sooner rather than later. If it wasn't for the fact that time decay was an enemy, we wouldn't really care. You know, put it on 6 months in advance and just let it go whenever it's going to go. But we put the math in our favor so that when the stock breaks out, we are mathematically guaranteed to make money as fast as possible. Doesn't mean we're guaranteed to make a profit. I want to be very clear on that. It means if the stock breaks out, it still has to break out. We are guaranteed to make money as fast as mathematically possible. That's how we set these up. So, wow, looks like we're going to get another significant breakout out of the XJO, and that's a large triangle. It's a larger triangle than the one before, and look how big that move was to the downside. And then we came back up, retraced the breakout. Again, classic Elliott wave technical stuff. You have a triangle, it breaks out, the breakout gets retraced. Same thing as with gaps. Sometimes they get filled rather quickly. Sometimes the triangles are retraced rather quickly. Sometimes it takes a little bit more time. Everything's different. Every situation is different. All right, so let's go ahead and look at the Nifty. All of these that had triangles before made big breakouts. And you can see that we had the big breakout on the Nifty, and we recovered that rather quickly. There you go. There's your retracement. Literally happened in 2 days. So you had the breakout and the retracement, and now heading back, we filled this little gap here. It's kind of tough to talk about gaps here on these ETFs that are exchange traded, so that they ADRs, depository receipts that trade on the U.S. exchange, because they're geared towards international markets. And what happens overnight, by the time it gets calculated here, there's a lot more gaps, as you can see, than normal. So don't really focus on the gap filling as much here on ADRs as we do on regular type of issues. But look at, and this DMI is setting up like it looks like we may be getting ready to move lower on the Nifty, but it's not there yet. The ADX is not above the positive directional indicator. It's just there's really good separation between the two directional indicators. The ADX is moving up, but it's got to get above 20. It's almost there. Well, actually, is it there? Yeah, it did break above 20 today. So it has broken above 20, but it's got to get above that positive directional indicator. So we're not too far away from looking like a pretty decent downside trade on the Nifty. And that's one of the markets that had held in there so well for so long. And then the DAX, and we talked about this, and we talked about this, holy cow, in the SPY update, where this market just can't seem to catch a break. This is the third time that wave 5 is relabeled to a 3, which means that these targets here, boom, that was a wave 5 target. It relabeled to a 3, meaning we're going lower. That was a wave 5 target. It relabeled to a wave 3, meaning we're going lower. This was a wave 5 target. It relabeled to a 3, meaning we're going lower. And now with all of that, after 3 relabelings from a 5 to a 3, now we have the triggering of the DMI showing that, man, there's some strength. No, duh. This is kind of where you look at the DMI and say, yeah, that it doesn't take a genius to figure that out, that there's some strength to this downside move, but you got confirmation of the DMI now. And with that setup, it does look like things are going to go lower here. So, wow, the tax is just poster child for Elliott wave, really. I mean, it's been so spot on. Elliott wave has been on forecasting where the DAX is going to go, just mind-bogglingly accurate on where the DAX is. So I think it's EWG is another way you can trade the German market. Yeah, EWG, and you'll see that looks pretty similar chart. So that's why I was saying, don't tune out when we talk about the international markets, because you can see these things occurring, patterns, classic Elliott wave patterns showing up here. But my goodness, poor folks in Germany. So as interesting as the fact that Bitcoin is showing surprising strength, I think, in the face of what's going on. Then you look at the German market, where it's just like they just can't catch a break there, just keeps going lower and lower and lower. And I don't really know how their retirement plans and everything else works there, but when you see that kind of stuff, you hate to see it if it's affecting people's long-term retirements, etc. We are a little bit oversold here on the German market. Perhaps we get a little bit of a bounce. Seems like maybe we're setting up for perhaps the Federal Reserve comes in, they only do 25 basis points, and it gives us a little bit of a reprieve back to the upside. But man, it sure looks like we want to go lower in a lot of these markets before the selling is done and complete. So go to our website, look at the SPY. You can see what all the comments are. There's a lot of comments on people's opinions on whether or not the market has bottomed or not. Pretty interesting stuff. All right, so at this point, let's go ahead and see if we can find a case study consideration for, we got more to look at. Hang on, let's go over here and look at the past ones before we look at this one. Now, CMC we have twice, and we take a look at CMC. This was the first one. This was a bullish position that we looked at, and that was back on January 4th. And then we looked at it last week as a strangle, and we did send that out to our subscribers as a strangle. And you can see the breakout to the upside. So the bullish trade has gone up, nice breakout to the upside. And then from the triangle pattern set up here, you can see the breakout there as well in the triangle. So looking really good on CMC, both positions back from last week and on January 4th. And then we had Travelers. This is one that we looked at back on the 25th of January, where we had a potential target up around 175. We got almost there. So we got a high of 174.55. So you got awfully close. And if you look at the low there, was 173.19. And so looking at that high that existed back on 210, that's above the low. It almost hit the high dead in the middle. And then look what's happened since then. So we have a wave 4 scenario here. So the question would be, if you didn't exit back then, would you still be in the position? Well, if you're still in it, I don't see any reason to get out of it. But if you didn't get out of it back then, it's kind of why, because it did exactly what it was supposed to do. It clearly got above 173 at 174.55. So it got within the tap box. We had a wave 4 correction. Perhaps it could move higher. Might be a little greed factored in there. So I think we can go ahead and take that one off of our list. If you're still following along with it, I think you still have more to the upside, but it did hit our target price. Now, the next two, man, this is where you really start to wonder what's going on. You saw the rates going up, but then rates came back down. And the financials are really geared towards rates. And you can really tell both of these were two financials that we looked at, SF and FITB, back on the 8th of February. And you can see that both of these have moved lower since then. This FITB has been the better performing, but we broke a little bit of support there. Why? Because interest rates are coming down. Is it really that bad for the financials? So this is where I'm concerned that there may be something bigger going on here than what we're aware of. Interest rates have moved to the upside. Yes, recently we looked at the chart of the TNX, they moved lower, but that still should be a decent environment for the financials. Even with rates coming back down, it still should be okay. So to see these moves completely erased as they have been, just from a financial standpoint, it should be one of the better performing sectors, and it's not. They're getting crushed, at least they did today, on that move lower in rates. So do they rebound tomorrow? If the Federal Reserve only goes 25 basis points, is that going to help or hurt the financials? it might help the market, but hurt the financials, as crazy as that sounds. But financials like rates moving to the upside. Okay, fine. They like rates moving to the upside, but they didn't get crushed like this before. So pretty interesting. And it may be you want to keep a really close eye on the Fed meeting tomorrow, see what happens, and see if you want to stay in financials or not. And then AGCO is one we looked at on the 15th, and put the Elliott wave pattern on there. You can see we were in a corrective pattern. We had a pretty decent looking DMI, and we came down and filled the gap. Now we've bounced back up. We have a doji today. So this is one of those scenarios where the weakness in the market got this stock, but it's held support. So if you were following along with this one and you're still in it, I think you can stay as long as it stays above this 115 level, which is where there's support. You can see there was a bit of a triangle here, and then there's the big breakout of the triangle that occurred in February. So there's your triangle. So we did retrace that triangle breakout, and it's trying to move back to the upside. As long as you stay above 115, I think you can stay long. But if it breaks below that, then you would definitely want to exit that one as well. All right, so then last week we looked at CMC for the strangle with this triangle pattern, and I've already shown you what happened here. So really nice breakout, and again, we did send that out as an alert to our subscribers. Boom, look, the false breakout to the downside, and the big breakout was to the upside. Now, do you remember Dell? We looked at Dell, and we said we needed a follow-through day. So if we broke below, and I wrote this down because this is what we talked about, if we close lower the next day, you could look at that as a downside trade. We did close lower the next day, and look what happened after that. Boom. Did you follow that one? If you did, you had a home run. That was a massive move to the downside. So that's what we said last week. That was just last week, that if we got another lower close from where we were, so here's where we were. Again, if we got a lower close, okay, that's a downside trade, but we wanted the follow-through day, so we didn't say don't enter it now. Wait, get the follow-through day. Bam, to the downside there. So hopefully you followed along with that one and you really enjoyed the gain. So let's see what we can find as far as a case study consideration for tonight. And if we take a look, man, there's two on the bullish side. That's crazy. If you're not familiar with the software program is called Profit Source. You can find out more about it at the website hubb.com. That's B as in boy, hubb.com. To me, it's the best Elliott wave software that exists out there. It's programmed directly to the algorithm that Ralph Nelson Elliott wrote. There's a lot of Elliott wave programs out there that are personal adaptations of the Elliott wave algorithm. This one is exactly to what he wrote. So it's pure Elliott wave. I think it's the best one. I utilize it. A lot of our subscribers do. That's why they have this Elliott wave options tab here. So you get all of these pre-computed searches if you are an Elliott wave options alert subscriber and you have the software program. So it saves you a tremendous amount of time when you're going through and looking for potential trades. So we have Lithium Motors, and I think that's an EV company, right? I'm pretty sure they are. And that does look pretty good. Completely bucking the trend of what's going on in the markets. And you can see the DMI is set up pretty well. They did come down a little bit, but a pretty nice break over the last couple of days. And I would look at this one with a couple of concerns here. One, we're a tiny bit overbought, which is probably why we had a quiet day today. But then I also look at the resistance that exists right here. So just like we made a little note with Dell, I'm going to make a little note on this one for today. So I don't think we make this an official alert consideration for today. We want a break above 340. So for LAD, if it breaks above 340, because there's resistance there. And we're right there. And I would be surprised if we broke through it in the next day or two, because we're a little bit overbought. And when you get a little bit overbought or oversold, it's tough to break support or resistance in that scenario. Usually you need a little more energy, a little more momentum to break through support resistance areas. So the fact that we're right there at resistance at 340, I would just want to see it break above that. Now, the good thing is if it does break above 340, you're probably back at 380 in a very short period of time. So as weird as it sounds, that could be a pretty good bullish trade. And as crazy as the market is and how it looks like we may not be done with the lows yet. Perhaps we get a bounce in the meantime, but maybe not completely finished yet. So pretty interesting there. And then symbol VIVO is for Meridian Bioscience. This is when you get into the areas that tend to be more defensive. Bio stocks, when the market is a little bit weak, tends to be a place to go. Now, here is we have the complete opposite of what occurred with the Qs. We came down here, we didn't label a wave 4 to the downside here. So perhaps we're going to have a new high on the move to the upside beforehand. So if it works in one direction, it should work in the opposite direction, right? So we didn't quite make it to the tap box. So perhaps we're going to see a new high here, which would mean that we would take out this level right around 27. And then you can see we have the wave 5 forecast right at 30. So we're trading right now at 25. That's a pretty decent move back to the upside there. And you can see that we had this big rally here on the DMI. The ADX came back and now it's setting up again to try to move to the upside once more. So looking at that, I think you can see a potential move higher there. So let's go ahead and list that one as a consideration as well. Again, symbol VIVO, Vivo, weird symbol for Meridian Bioscience. There must have been a buyout or something else along those lines. Some story behind the stock symbol behind that. Now, another thing that we might want to look at when we see where the market is and the fact that we're building a larger triangle is consolidating stocks. The issue that I have right now is we tend to stay away from entering a new strangle when the VIX is above 30 and the VIX is at 33 on the close today. So there's a lot of potential consolidation patterns. You can combine the consolidation patterns with the wave 3. There's 3 of them there. Let's see what it looks like to see if there's consolidation within a wave 3. That was a buyout, so that one doesn't count. Take a look at Cisco. This is the food company Cisco, not Cisco, the electronics company. And pretty nice ascending triangle here that we're breaking out of now. This is another area that would be considered kind of a defensive sector, with a move back up to potentially 95 or so. That's kind of interesting. And then Rogers, another buy. Oh, sorry, look at that one before. That was the buyout. TDG, another ascending triangle pattern here that hasn't broken above the resistance level yet. TransDigm Group, not really familiar with this company, but it's a pretty nice ascending triangle. Elliott would look at that because it's in a wave 3 and he'd say the likelihood is that breaks to the upside. I would say that when you have triangles, my viewpoint is when you have a triangle, you have to look to both directions. A triangle could break either way. It can break to the upside or the downside. Maybe it breaks higher and it moves up above this wave 5 target. I'm just saying that it's been my experience that triangles can break either direction, whether ascending, symmetrical, or descending triangles, cover both directions. That's what we do in the volatility portfolio with our strangles. So we still have that issue of, do you put on a strangle, especially on an expensive stock, when the VIX is above 30? So normally that is a rule that we don't do that. Let the VIX come back down. So I would say this is one to keep an eye on, but I just think the options are a little too expensive unless you had a significant move you could get a nice breakout and not make money or even lose money if the VIX came down. So if the breakout was to the upside and the volatility comes down quite a bit, which is likely where the VIX is going to go, lower rather than higher. I mean, who knows? Maybe the VIX does go higher, but if this broke to the upside and the VIX went up, then you could look at me and say you were wrong. It wouldn't be the first time I was wrong, I promise you that. But in general terms, those are two to keep an eye on, I think. But I don't know that I would do anything with those Cisco and TDG, just because I'm concerned about the fact that the VIX is so high. All right, with that, I'm going to go ahead and bring Zach from support back in. He walked you through the process of asking questions. We have a few more minutes left, so we'll get to as many questions as we can in the time allotted. Are you there, Zach?
I am. And as you mentioned, we've got tons of great questions that have come in from both Zoom and YouTube. So we'll try to cover a few before the session ends.
All right, fire away.
All right, we'll start out first with this one from Zoom from Peter. Could you please assess OIH? What is the possible move ahead, and explain the price difference with oil prices? Thank you.
OIH?
OIH.
Yeah. Oh, geez, you're not gonna like this. I meant to mention this when we were talking about the markets, but we talked about the oil future. The USO is up over $2 in after hours trading. So as bad as oil prices have been, it looks worse. Now there's a lot of time between now and when the market opens tomorrow, but we closed just under 72 on USO, and we're trading at 74.32 right now. So almost up $2.50 on USO, which means that OIH is likely going to move to the upside tomorrow as well. And, that doesn't feel good at the pump. When you're going to fill your car, prices aren't going down anytime soon. It doesn't look like. So these ETFs, these are different companies, and they have slightly different structures on exactly how they construct the ETF. In general terms, as I'm sure you're aware, they're designed to mirror the price of oil. Exactly what's within the ETF varies from investment company to investment company. I'm not familiar with exactly what VanEck has within theirs, but you can see it's moving to the upside, maybe not quite as severely as oil has been. Here's the USO, and you can see there's slightly different chart there. Also, an ETF, and then that's going to gap up again if the futures hold going into the open tomorrow. You're going to see another move to the upside. And I had talked about this before, that I'd seen some pretty extreme projections. I felt like oil was going to go to 100, especially when we hit 93. I didn't think we'd stop there, that we'd likely see 100, but I saw some projections of 120 for some people that fairly knowledgeable in the oil. And I thought that was a bit of an extreme. They may be right. We may go that high, which is higher than where I thought we would go. So anyway, long-winded answer there, but the ETFs are designed to follow oil. Why the OIH isn't quite as extreme to the upside as the USO, I'd have to look at the exact structure of it. I'm just not familiar with it, but that's how ETFs work.
Thanks for that, Rob. And while we're talking about oil, I thought this was an interesting one that came in from YouTube from Seth. Thoughts on crude oil, Mr. Roy? I tend to play drip or gush over the ETF.
I can understand that, and likely getting a bit more bang for your buck that way. And so, I mean, I've just covered off that, if you're long those and we stay where we are, you're going to have another happy day tomorrow. Maybe it backs off. Who knows what's going to happen overnight? That's the thing with the VIX above 30, is even the futures are crazy overnight. But at this point in time, if you're long those, then you're probably going to be a happy person tomorrow, Seth.
Absolutely. And going back to Bitcoin, I thought you might find this interesting. Susan wrote in that she heard Bitcoin was up due to Russia needing somewhere to put their money. And I saw a few other comments come in as well of that same narrative.
And I did read that. I did read about that. And it makes sense, doesn't it? If we're going to be trying to freeze assets, if we're going to be looking around to freeze assets. They took them off the SWIFT program, which is a way to transfer money internationally. If you're not familiar with what that is, without getting into too much detail, they're doing all these things designed to, hurt Russia financially. And I did see that Bitcoin is a place where they could still do commerce, still exchange currency, if you will, because I guess it is a digital currency. But yeah, I did read those things too, so I appreciate the comments, and that may be exactly why I said it's impressive in a risk off type of environment that Bitcoin's been doing well. So that answers the question, doesn't it? It does make sense. So yeah, I understand the comments and appreciate it.
Absolutely, it'll be interesting to see. So next, with a couple more minutes left, Jordan from YouTube would like to look at Vale, VALE.
Yeah, we're staying on common theme here, oil, and that's pretty vertical. My only concern here is we're getting a little bit away from I think it's volley, by the way, dude. Not that you would know that, but
now I know.
Yeah. So we're getting a little away from the 10-day moving average here, but like I said, if oil holds into the open tomorrow, it's going to be further away from the 10-day moving average. So I think we're going to get to a point, whether or not it's tonight after the open tomorrow, where we do get a little bit of a backing and filling some with oil. But I think there's a great chance that wave 5 target gets hit. It could get hit in the morning. The DMI is, it's reformed and showing that there's strength behind that move. So we closed at 1886. We have a target at 22. Maybe it doesn't hit that tomorrow, but I think there's a very high likelihood that we go up there. I don't think oil prices are going to be spiking back down anytime soon. They tried to today by releasing some of the strategic reserves, and it didn't have much of effect, did it? So, the market just kind of shook that off. We did get a little bit of a pullback after that was announced on oil from noon to about 2 o'clock. That was it. That was about it. And then we started a creep back to the upside, and then we've gone significantly higher. So the news of releasing oil from the strategic reserves didn't carry much weight for very long. And so I don't think it's going to hurt this one either. I think you're going higher here. At some point it needs to rest because it's overbought, and it'll be further overbought tomorrow. But you just add to it during that time frame or take your gains tomorrow.
All righty, and we are at the hour. So in closing, I might just leave you with this final comment from our very own John. Wrote in to notify that when looking at Cisco, rates are 100% on the integrated investor VG growth model, in addition to being technically strong. So that'll be one to definitely keep an eye on.
Okay, yeah, thanks for the comments.
All right, well, we're at the hour, so if you want to go ahead and wrap up, I'll pass back over to you.
All right, thanks, Zach, and I apologize. I ran a little bit long, and we didn't get to as many questions as we'd like to. So those of you that are viewing, usually like to spend a little more time on the Q&A. Please visit with us again next week. Love to have you. We do this each and every week. It's free. As you know, we talk to markets, and there's just a lot of talk about regarding the markets right now. But if you have particular symbols, we're happy to take a look at what our indicators show for you. So I sign off all these things the same way every time, but it's very heartfelt. The fact that time is the most valuable asset that we all have. We very much appreciate when you devote some of your valuable time to viewing our content, and in turn, we try to make that as informative and educational as possible regarding the content. So thank you for watching. Have a great week. Promises to be another interesting week, and we'll have